Recently, the National Bureau of Economic Research (NBER) announced that U.S. economy ended its recession in June 2009. That's the month the U.S. economy began to expand again after 18 months of decline. It was the longest recession since the 43-month recession that began in 1929 and ended in 1933. We have Mr. Adrian Chew, CFD dealer, to share more with us. So Adrian, what should investors be expecting in the near future?
Although the NBER reported such good news, investors have to understand that the meaning of this word recession and expansion. A recession means that a period of declining economic activity, while an expansion is a period of increasing economic activity. Having said that, this ruling is not a confirmation that the US economy is growing at a faster pace, it's just that it has stopped declining. Having said that, the US economy remains very troubled as millions are still unemployed, millions of homes are still at risk of foreclosure. With the reference to the 1929 to 1933 Great Depression, unemployment rate remains high for another 7 years to the World War II. Thus, to say that a recession is over does not indicate how far we need to go before we can grow again.
With the increasing merger and acquisition activities, do you think it is an indication of companies being confident of the economy?
Indeed, there are more M&As reported recently. This is due that American companies are still holding on to record sums of cash. It could be seen as a reflection of their anxiety on the health of the US economy. The Federal Reserve has reported recently that non-financial companies held $1.84 trillion in cash and short-term assets at the end of second quarter, just shy of the highest recorded sum in the first quarter. However, I feel that these mergers and acquisitions are unlikely to give the economy much of a boost. This is because most of the acquiring companies tend to eliminate jobs instead of adding them. Thus, this will continue to stress the already high US jobless rate and the weak consumer demand. I believe that companies are still reluctant to invest heavily now until they see more evidence that the US recovery is accelerating. One area to look out for would be the small businesses. One of the biggest engine of US growth has recently announced that they have reduced debt for 5 straight quarters, evidence showing that they are still unwilling to expand more.
Going forward, what are your views on the global economies?
On a more positive note, the World Trade Organization recently raised its trade growth forecast for year 2010 to 13.5% from 10%, citing a faster annual expansion in the global commerce. It now expects export for developed nations to expand by 11.5%, an upward revision from 7.5% forecast made in March. The expansion in trade volumes was much higher in the first quarter this year. As for both developing and developed nations, as they climb out of the worst economic slump since World War II. China posted a 41% gain in export in the second quarter, while India export were up by a third, according to the recent data by the trade body. However, the WTO warned that output growth would slow down in second half as government measures to stimulate the economy are ending. The companies are also winding down their restocking. Nevertheless, trade figures released by some countries for the early part of the second quarter indicate that growth was continuing. For example, the United States reported that export in July has reached their highest level in 2 years.
Thank you, Adrian. That's all we have for you today. Tune in next week for more market updates.